The once powerful economy of Britain is great no more. The UK's finances are in turmoil as mortgage rates have soared. The pound has crashed to record lows and chaos in bond markets threaten the country's future. How did the nation home to the world's global financial center fall so far from grace? In this video, we'll cover the recent events that have directly led to the United Kingdom's wave of financial panic and disorder, beginning with the UK's central bank and a prime minister who had a shorter shelf life than a head of lettuce. The Bank of England has been scratching its head for months trying to solve the problem of the rampant inflation eating away at the British public's wealth. Desperate, the BOE decided to increase interest rates by half a point. It had no way of knowing how severe the impending storm would be. To add fuel to this growing fire, the British government, under the leadership of the ill-fated Liz Truss, announced the largest tax cuts in half a century, betting big on growth at the expense of the country's finances and its standing among investors. Her Thatcherite bet would result in Truss's 45-day tenure as a prime minister, the shortest of any leader in the country's history. After UK Finance Minister Kwasi Kwarteng doubled down on this reform proposal by hinting at more tax cuts to come without explaining how to pay for them, the pound plummeted to an all-time low versus the US dollar. Then bond prices dropped. Interest rates shot up, mortgage rates spiked, and pension funds almost went bankrupt. The increased likelihood of a worldwide recession and the wild swings created by the United States Federal Reserve's aggressive stance against inflation via 3 massive rate hikes had already set the financial markets on edge. The British Conservatives administration has found itself in a politically volatile environment. The UK's central bank then announced that it would print $70 billion to buy government bonds in an attempt to protect the economy from the fallout from the Truss growth plan, after verbal assurances from the UK Treasury and Bank of England failed to calm the panic. The administering of immediate first aid has halted the bleeding, as the pound has begun to stabilize against the dollar. It seems that the wound has not yet closed. The next several weeks are going to be quite important. Former co-head of the world's largest bond fund, Mohammed El-Erian, said the Monetary Authority has gained some time, but would need to move again fast to restore stability. Prior to the next meeting on November 3rd, the Bank of England will likely be forced to undertake an emergency rate rise of 1 full percentage point. Truss tried to pass the buck and blame the market fluctuations and the sudden increase in energy prices solely on Russia's invasion of Ukraine. Investors have all pointed out that her administration only provided a partial solution. So, economic catastrophe continues to unfold in the United Kingdom, but one that has been brought on by the country itself. Cutting government expenditure is the only way to balance the budget, but that's politically risky for the same reasons. The economy is about to tank. Public services are already stretched thin, and workers have demonstrated they're willing to walk off the job in huge numbers if they don't get a raise. The foreign investors who keep the British economy afloat will be left wondering, giving skeptics enough opportunity to cast new doubts on the UK government's commitment to budgetary responsibility. This puts the Bank of England in a difficult position. It's possible that it won't be long before it needs to step in again, this time with an unexpected increase in interest rates. However, there has been some renewed optimism in the past week with the departure of Truss, but it is unclear if the new prime minister will be able to reverse the country's course. Now, Rishi Sunak, Britain's third prime minister in the space of 7 weeks, has made a commitment to rectify the errors committed by his predecessor. In his first address after taking office at number 10 Downing Street, Sunak said, "This will mean difficult decisions are to come." When Truss assumed office in September, the United Kingdom was already in the process of entering a recession due to the rapidly rising cost of electricity, which had a negative impact on consumption. Now, Sunak faces a new challenge. He needs to restore the government's credibility with investors following the bond market revolt that was sparked by Truss's unfunded tax cuts. This revolt has required the Bank of England to step in again and intervene to prevent a complete collapse of the financial system. The prices of borrowing money, especially rates on mortgages, have skyrocketed. To be successful in achieving this objective, Sunak will need to provide a comprehensive strategy that outlines how to set the country's finances on a course that's much more stable. Easier said than done. In July, a government watchdog issued a warning that if serious action was not taken, the debt of the United Kingdom might exceed 320% of its gross domestic product in 2 generations. What's the issue? After years of austerity in the aftermath of the global financial crisis that occurred in 2008, there is little enthusiasm for further reductions in government expenditure. In addition, the failure to assist people in coping with rising expenses of living might prove to be politically disastrous and put more pressure on the economy. Where will this badly needed extra money come from? Finance Minister Jeremy Hunt got things moving when he undid $37 billion in tax cuts that were the foundation of Truss's strategy to increase the economy. This move was a key component of Truss's failed plan. According to the calculations done by the influential think tank IFS, Sunak and Hunt still need to find between $30 billion and $40 billion in savings in order to bring down the public debt as a share of the economy in the next 5 years. And if investors don't buy into their strategy and borrowing rates skyrocket again, it'll only grow more difficult to keep the issue under control as interest payments on government debt climb. If the financial markets don't buy the new plans, then it'll be considerably more difficult to close the budget gap. There has been a lot of speculation on whether or not the current Conservative government would attempt to avoid increasing state benefits and pace with inflation, as is often done. According to the statistics on inflation, the majority of working-age benefits in the UK are expected to see an increase of 10.1% in April of next year. However, there is a second thought that suggests the rise might instead be connected to average wages, which are expanding at a pace that is far slower than inflation. According to IFS, this might result in a savings of $8 billion in 2023 to 2024. A move of this kind, however, would generate a lot of controversy, particularly considering that the benefits have not been raised to match the rising cost of living in 2022. Increasing the amount of taxation paid by companies might be a more acceptable choice, at least for individual families. It has already been stated by Hunt that the rate of the company taxes would increase from 19% to 25% in the spring of next year. Hunt may potentially target gains from oil and gas corporations by expanding a windfall tax on profits. This tax would target unexpectedly high profits. Already, industry groups are banding together to protect their interests. Banking trade organization UK Finance said that its members already paid a higher rate of taxes overall than any other sector, and it encouraged the government not to endanger the competitiveness of the United Kingdom's banking and finance business. It's also possible Sunak might back out of Truss's vow to increase military expenditure to 3% of the GDP by 2030. But doing so would have its own set of political dangers in light of Russia's ongoing conflict in Ukraine. It has been announced that other nations in the area, such as Germany, would increase their military spending, and it's possible the United Kingdom may be reluctant to fall farther behind. The UK could be looking at a death spiral. Both investors and economists anticipate that the government will soon propose a package deal that will include both increased taxes and decreased expenditure. In spite of the budgetary about-faces, the administration will still have to demonstrate a plausible route in the budget that will bring the books into balance. This, ironically, could make the situation much worse for the nation itself. The Bank of England has predicted that the United Kingdom is already in a recession, and an indicator of business activity in October sank to its lowest level in 21 months. There's been a major change in the fiscal picture, which has gone from being far more lax than anticipated only a few weeks ago to being much more stringent now. There is a possibility that the recession may be more severe or last for a longer period of time than the government party in Britain anticipates. A weakened economy would bring along its own unique set of challenges. Nobody wants to make the same mistakes that were made during the short Truss administration, when she bet that unfunded tax cuts would kickstart growth. However, business groups are sounding the alarm that if the goal of bolstering Britain's sluggish economic development were fully abandoned, it would cause further challenges. The fiscal restraint imposed in the 2010s resulted in extremely slow economic growth, little increase in productivity, and reduced investment. The UK runs the risk of falling into a similar kind of death spiral, in which the only way out is to keep returning year after year to the same dead-end problem, in order to find new ways to raise taxes and slash spending, since there is no growth to look forward to. How do you see the looming crisis in the UK? Is it overhyped panic? Or Are things in fact much worse than they already appear?